You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right. Well, let's look at a trade from last week. We've had quite a few trades go in our direction, and as always on Options Playbook Radio, they're not meant to be recommendations. We're only doing this as a learning tool, and it's easier to learn on trades that have gone against you than the ones that actually go with you. Because if they go with you, like they did a couple weeks ago, and you are correct on your forecast, it's very easy to know when to get out. The problem is when you're incorrect, what do you do? And last week's trade that we looked at on Nike was a diagonal spread. It was something different. We haven't done a diagonal spread as a long spread. We bought the most at the money option contract and sold one further out, and then we did it diagonally. So in other words, we did two different expirations. So I find this a great learning scenario, honestly, what happened with the trade because of the way the market went. If we look at that Nike trade, remember we were just going to be a little bearish because it's had a run up because of their advertising campaign. They're doing well. We just wanted to get long a put to go into earnings, kind of one of those things where you buy the rumor, sell the news, that type of thing. So hopefully after earnings, after a big run up, we're thinking maybe they would be bearish. That was our only thought. We flipped the coin. We did a diagonal spread because there's a lot of juice in the option contracts in general, just because of the news, and then you toss in the earnings. So we sold a put further out of the money with a nearer term expiration, which means we also bought a put further out in time that was closer to the money. So what we did was buy the September 28th 82 strike expiration, and we sold the September 21st, 1 week earlier, 81 strike expiration. The earnings were going to be announced on the 25th, which basically means the 28th is that earnings expiration. The stock was at $83 when we put on the trade. Total net midpoint of the trade, because we were doing it on paper, was 62 cents, which means that was our total risk of the trade all the way up until that first expiration date. Whatever you pay for this trade was our risk. There was no additional margin requirement because we bought the more at the money one and sold the more out of the money one. So since we put on that trade, the market was closed, and that was the 14th of December. So that was the 12th of September. The market was closed at the time. And since that day, the market really hasn't cooperated at all. The next morning it opened up, and then it continued on up. Now, we would like it to just stay neutral. We sold that one option contract for 30 cents. Our whole goal was that we would capture that 30 cents before the expiration date. But if it did go down, we were net long delta, and we were going to be profitable on it. We didn't mind that at all. But our whole goal was to try to get into a long put at a fairly reasonable price. So the market right now closed today at 83.43, and we are taping Options Playbook Radio after the close on the 19th of September. And it was down a little bit, but bottom line is the market has been up since we put on the trade. That is the wrong direction. So what do we do? If we go out, we look at the option contract. The one that we are long is still fairly expensive. And the reason why, even though we've been dead wrong on the direction, the market has actually gone up. Well, right now it's up $1.43 from when we put on the trade. And that option contract is trading for $1.20 by $1.31. So let's call it $1.25. We paid $1.62 for it. And guess what? The 81 strike that expires a week early is basically trading for nothing. It's actually 2 cents by 3 cents even after market. So it's basically zero. So what has happened? Implied volatility has gone down on the 21st expiration, and implied volatility has increased on the one that expires after earnings on the 28th of September. And that is the main reason why we're still okay on this trade. Some people can make an argument as if being down approximately 40 cents is okay, but that's where we're at. And we have options in this scenario. The front month hasn't expired. We can wait until that does and see where we're at, but we have to tape the show on one specific day. So what we would look to do is maybe buy to close that option contract. At this point in time, why wouldn't you do that? If you could pay 3 cents for it, just get out of the trade. And if you wanted to, you can just remain long your option contract. Basically, you're down about 40 cents on the entire trade, and we could remain long the put that does expire after the earnings report. We can anticipate implied volatility might go up. We might get a movement down. We got a few days to play because now we basically captured the 30 cents on the 81 strike call that we've already sold. Now, a more common thing, and I think I might have mentioned this on last week's call, and if I didn't, shame on me, but we talked about maybe rolling into a long put spread or a bearish put spread that both option contracts contain the earnings. So what might we do? We're long an 82 strike put. Let's pretend we bought the 81 back for zero. Market right now is at $1.25 approximately at the midpoint. We could go out and sell an 80 strike put with that expiration. And that 80 strike put at the midpoint is trading for about 70 cents. So gets interesting in that. So we paid $1.60 for this trade. We paid $1.60 for this trade. We're going to bring in, let's call it 70 cents just to make sure. So we're rounding everything off here. And we are now going to have a cost basis of 90 cents on the trade. And and we still got the probability, or we still got the net that we are still bearish on this market, and we want this underlying to go down. So I find this a very interesting scenario in that we were dead wrong, but we really are still smelling pretty good on this trade in that if we close out the 81 strike put that we wanted to expire worthless, the market has moved against us. We roll into our put spread, and we got this entire trade on now for basically 90 cents. We got in total cost on this trade and in total risk. Now, if you just did this trade flat out, right? We did it for 90 cents. We're trying to do, we don't want the cheese anymore. We just want out of the trap. If you were to come in today, begs the question, and just put on the trade, you could get it done for about 60 cents, right? So we're down 30 cents overall on the trade, but we did make money on that one option contract that we sold that basically expired worthless. We're buying it back for pennies. So there is some benefit. So interesting trade, and that's part of the reason why I like to talk about Options Playbook Radio. I kind of like when we look at trades and they go against us, because then we can talk about, okay, what do we do now? And I think that that's a very viable solution. So now you have a 2-point wide long put spread. The maximum it could be worth is 2 points. You are still forecasting the market to go down. You want it to go down to that 80 level by the expiration date on the 28th. Probably ride this on into earnings. You have a total risk of 90 cents. Total max gain of $2, so you can make $1.10 if you're correct on your forecast. And the market expires below that 80 strike after the earnings announcement. So that's going to be it for last week's trade. Let's look at this week. And what's big this week and what's holding up the whole market is the ganja stocks. And the puns are really rolling on all the financial news services. And I wish they would just make a law that it was illegal to pun about weed stocks, because it's nonstop. And they're really, at this point, just getting annoying more so than they are being humorous. So with that mentioned, let's look at a trade. And basically what I'm going to say to you, and here's the reason why I'm bringing this up, is because it's all over the news. Specifically, the one stock is TLRY. TLRY, that's T as in Tom, L as in Larry, R as in Robert, Y as in yellow. That underlying has gone up over 100% basically in 2 days. The stock is crazy. Today it closed at $214.06, up $59 today. Yesterday, I think it closed up $30 approximately yesterday. So not meant to be a recommendation at all, but I'm really going to talk about it because I just want to warn people more than anything. And I think it's a very valuable learning instance when you get a stock that's just doing something that just is absolutely insane. And this starts, and the reason why I brought up this topic is I had a good friend, a very good stock trader, a day trader, and has made his living doing that for many, many years, just called me up and said, hey, I'm looking at the put options relative to the call options in TLRY. The puts are way inflated. Obviously, it's a new stock, doesn't pay a dividend. There's nothing going on. You know, it looks too good to be true. What's the problem? And so I pulled up the option chain, looked at it, and yeah, sure enough, if I go out just 30 days in time, and including today, I'm going to go to the monthly expiration in October, which is exactly 30 days away. The market closed today at 214. Okay, so let's just look at the 210 call, because I got 10-point strikes. We see that the put is out of the money. So remember, the market is at 214, and if we look at the 210 call, that is in the money. The 210 put would be out of the money. Everybody agree with me on that? And we have extremely wide bid-ask spreads in this because of the way that it is moving. So I'm just going to talk about the midpoint in general on this underlying. So if I pull up and just look at the midpoint of this trade, we see that the long call is trading at about $40, and the long put, and I'm rounding off here, is trading at about $82, almost double what the call is trading at. Almost double what the call is trading at. And maybe the call's at 45, but we'll just say it's almost double. Now remember, the put's out of the money and the call's in the money. We know the stock doesn't pay a dividend. So to answer my friend's question that shot me an email over the weekend, well, we were having a hurricane, by the way, here in Charlotte, North Carolina. And the answer is, it's a hard to borrow a stock, and it's a really hard to borrow stock. So basically there are no shares to be able to short, to be able to complete the formula that is needed to keep option pricings in line, quote unquote, and I say that in quotes because they are in line because of this, but the puts are way inflated relative to the calls because of the hard to borrow situation. And I don't think that there's ever been more of a hard to borrow situation than this underlying stock that has ran up 80 points in 2 days on a brand new stock, only because they just had some news event that basically says they can sell some of their product to the United States. That's all it really was. It's a Canadian company. So because of this, and because of what's going on, you can't sell the stock short, and then you got to pay an extremely inflated price for the puts. So on Options Playbook Radio, I usually talk about doing strategies. Here's my strategy. Lay down until the urge goes away. I don't think that this underlying is for anybody to mess with, but if you are going to be trading anything whatsoever, early exercise on the calls can happen, on the puts. Everything is feasible in this underlying if you're going to trade it. Huge bid-ask spreads. It's going to be hard to get in. It's going to be hard to get out. But if you do any trades in this underlying, I would be doing spreads. I would not be buying options outright. I would be looking at trying to spread it, mainly because you can work the order a little bit better. You can take a little bit of the juice that is in it. That one put option that I was just talking about, my systems are showing me an implied volatility of 375%. The call implied volatility is at 188%. And a lot of times you will see that skewing in volatility because of the hard to borrow issues. A lot of models have problems figuring out exactly what that interest rate is to get short stock. And that's exactly what hard to borrow means. It means that I have to pay to sell your stock on the market and be short that stock. And I have to pay every day that I am short that stock just so that I can have the quote unquote benefit in my mind of being short those shares of stock. Because whenever you sell stock, you're actually selling someone's shares. You're selling someone else's at the brokerage firm's shares, and you're borrowing them for the short time period. And if you do find the shares to get short, well, you got to realize that you can be called in at any point in time because of the short squeeze in general. If the brokerage firm comes out and says, we need your shares back, we have other people at the firm selling them and they're net long and they're selling to get out of their position, so we need your shares back so that we can sell them. That is a viable thing that can happen. So I'm going to go back and let's summarize what we talked about for Options Playbook. Not meant to be a recommendation by any means, but here's my recommendation. Lay down until the urge goes away on some of these marijuana stocks. There you have it. All right, that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. And until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.